All right, let's get into it. Thank you guys, everybody, for coming today. I am with Timmy Soul of Federal Hill Mortgage, and we are covering HELOCs. Um, for me specifically, I wanted to provide value to all my clients and people in my world, all the homeowners out there. I'm currently going through this process of leveraging the equity that I've built in my second home for a HELOC. I've had clients also leverage HELOCs to purchase investment properties and get their increase their portfolio real estate. And so I think the idea here is not everybody understands HELOCs. With some people, they may have a bad connotation or they just might not be educated about it. So I wanted to call in one of the best to talk about HELOCs and specifically some of the programs that they offer that other companies and other mortgage companies don't. So this is me. For those who don't know me, I'm Daniel Walcott. I'm a realtor with MG Residential and Keller Williams Capital Properties. Been with the team for about 6 years now. I service, our team services the entire DMV. We work with both buyers and sellers. Last year, we sold just over 150 units. And so we are here to provide as much value to our clients and people in our world as possible. And Tammy, I'll let you tell a little bit about you.
Sure. Great glamour shot there of me. Thank you. Thank you, Daniel.
Of course.
First, it's a real pleasure to be on this call. I like to start any new conversation with a new client or on a presentation just by introducing myself just in 30 seconds or less, because I don't want this to be about me. But just to give you a little bit of background, as you can see here on the slide, I am the president of Federal Hill Mortgage, but I'm also the original founder of Federal Hill Mortgage. We opened the company in 2005. So we've seen it all. We've been through the 2009 situation. We went through the COVID. The last year has obviously been tough for the industry, but I've gone through many market cycles. A little bit more about me is I have also been a licensed attorney for 22 years. I don't practice anymore. I don't give legal advice, but I operate my business and my practice and the way that I interact with clients differently because I come from that world. I approach everything from a consultative position. Courtney will tell you, Courtney's been working with me for a couple of years now, as opposed to a sales-driven approach, which is what most loan officers approach mortgages from. Um, I am in Maryland. I cover Maryland, Virginia, DC, PA. We're actually licensed in 7 states nationwide. And in the state of Maryland, which is my home state, I am the #1 producing loan originator. So, Daniel shared with you his numbers. I'll just share with you that last year, even in the market that we're in, a very difficult market, I closed 185 million in mortgages. There's a lot of mortgages that I close, okay? And the thing that I'm here to talk about is, like Daniel said, HELOCs, or just in general, getting equity out of properties, which is a very common question that we get. Right now, property values are high, right, Daniel?
Absolutely.
Property values are high. People have equity in their properties, and many people want to be able to access that equity in most cases without having to disturb the mortgage rate that they have on their first mortgage, right? Because in 2020 and 2021, so many people, what did they do? That they refinanced. So they have 2% rates, 3% rates, 4% rates on their homes. And the traditional way to get equity out of your properties is, as everyone knows, to refinance that mortgage, right? But what happens when you refinance that mortgage, Daniel?
You lose it. You lose your rate, and now you have to take whatever rate is available to you today.
Right. Which, by the way, may be a good option in certain cases. And we're going to cover that. We're going to cover cash out refinancing, but it's not the best option in all cases. And that's why we as a company have created, and we're not the only ones that have it, but I believe we're the only ones that have it, have the variety of HELOC options that we do. We have a way for people to get equity from their properties without necessarily having to refinance. And that is, of course, the HELOC. So, Daniel, I think the first thing you wanted me to cover was how to calculate home equity, right? We'd like to cover that.
Yeah, absolutely. And for those who don't know, equity represents the ownership that you have in your property. And so the whole idea with the HELOC is that it lets you tap in and use that ownership that you have to meet, obviously, your various financial needs. We'll talk about the different options of what you can do with a HELOC and how best to use it. But absolutely, go ahead, Tammy.
Right, exactly. So that's all that equity is. Believe it or not, I get this question a lot. They say, well, how much equity do I have in my home? Well, I like to use the example of $100,000 valued property. Obviously, all of us on this call, for the most part, properties are worth a lot more than that. But the $100,000 property is the easiest one to use as an example. So if you have a property that's worth 100,000, you owe 60,000, then the equity that you have is 40,000, right? That represents it's the value less what you owe on the property. And that's what home equity is. Now, whether you decide to cash out the property or whether you decide to take out a home equity loan or line of credit, which we'll cover, you're not going to be able to capture that entire 40,000. Okay, you're not going to be able to get all 40,000 through a cash out refinance or through a home equity line of credit or home equity loan. Looks like someone is asking a question. Okay, not for me. So the amount of money that you'll be able to take out will depend on what vehicle that you use, but that's the equity in the property. So I see here, so exactly, so $550,000 current appraised value, $300,000 current mortgage balance. That means that you have $250,000 in home equity. However, if you do a cash out refinance if it's an investment property, you can't take out more than 75% of the equity. Okay, so if it's $100,000 value property and you owe 60, the maximum amount of the mortgage that you'll be able to get on a cash out refinance is 75,000. Now, if it's a primary residence, you can go higher, you can go 80% or more. But one of the reasons that people use home equity lines of credit is because not only does it make it possible not to have to refinance the entire mortgage, but they're able to get a higher, what we call loan to value ratio. Does that make sense? Does anybody have questions about that?
Yeah, put in the chat if you have any questions regards to the actual amount, right? Because I think what we're talking about is the equity is what you have, and you can only use a portion of that depending on which strategy, which we're going to go over all of them, which strategy you use to leverage that equity.
Correct, correct.
So also put in the chat really quick, if you had X amount of equity, right? Whether it's 40,000, 75,000, or 200,000, what would you do with it, right? Because I think that's the general idea. We don't want you to take extra loans out or borrow against your home if you don't necessarily have anything to do with it. And so there's different strategies that we can use with the HELOC, and so we'll definitely go into those. But for those, we just kind of want to get some ideas flowing. If you did have X amount of equity that you could use, what would you do with it? Go ahead and throw that in the chat. Tammy, I'll let you continue.
Right. So Daniel, actually, we've gotten a lot of answers to the question you just asked. So before I move on to this next, let me address these because these are fantastic. So let me tell you what I see. I see buy another house, invest in another property, which is the same thing, right? Pay off existing debt, maintenance, repairs, projects. Absolutely. Those are the reasons that people use home equity. Can you use home equity to go on a vacation and buy diamonds? You can. Nobody's going to stop you. We don't ask for what you're going to use the money for, but these are the most common things that people use the equity for. In fact, the number one that I see is buying another property. People are now recognizing that they have equity in their properties. They want to go, especially real estate investors, they want to go reinvest. And guess what? If you're looking to buy another property that is maybe a rehab that needs work, traditionally the way to finance that kind of property is through hard money. Now, if you don't know what hard money is, it's just very expensive money. You have to pay 14%, sometimes 15%, pay a large amount of points. But if you have equity in any property that you own, whether it's a primary home or an investment property, you can just draw what we're going to talk about here, a HELOC, which is one mechanism. It's not the only one, but it's the most common one, a home equity line of credit, and basically taking advantage of the equity that you have in any property that you own without having to refinance the mortgage. And then you can use that money to buy another property, for example, right? This is very, very common. Many people do this, at least many of my clients do this. And then in many cases, what they do once they buy that property, they'll fix it up. Maybe they'll sell it. And then when they sell it, they pay the home equity line of credit back down. I'm just giving you one example. This is not the only way to do it, right, Daniel? One
Absolutely.
example, they'll pay that home equity line of credit back down, and then they've walked away with a huge amount of profit. Now, they could accomplish the same thing with hard money, but the difference is the hard money costs so much. At the end of the day, they're going to have less money in their pocket because that hard money interest rate, the hard money points, the hard money fees would have eaten up a big chunk of the profit, right? Something else that they do is that they'll use a home equity line of credit to maybe purchase an investment property that doesn't need work for cash, because cash is king. You can put a cash offer on a property and get a better deal. And then afterwards, then we give them a mortgage on the home that they just bought, that they don't have a mortgage on, and then they pay off the home equity line of credit and then do it over and over again. So I'm just sharing with everyone a very common use of the HELOC. Real estate investors use this in order to leverage and buy more and more properties and then build wealth over time. And I know Daniel has seen this a lot. I've seen this a lot. So let's go to what is actually a HELOC. Actually, did we already cover that? HELOC. So it's a home equity line of credit. Okay. It's a flexible line of credit that lets you do anything with. You do anything you want with, and you don't have to explain yourself. Okay. It's really like, I don't like to use this example, but it is a good example. It's like a big credit card that doesn't have credit card interest. So it's a big credit card that has a lower interest rate than a credit card. It's tied to your home equity. Home equity. It's based upon the home equity, and it's deductible. So it's a deductible expense. Many people also use it if they have a lot of debt. Put all of their debt, use the home equity line of credit to pay it off. They're paying less per month, and it's a tax deductible expense, right? So upfront costs, just to let you know what the upfront costs are. Now, if anybody has any questions, please let me see. No questions. Please feel free to interrupt because I want this to be interactive. But you do have upfront costs with an appraisal, with a HELOC rather. Sometimes an appraisal is needed. Actually, I'm going to let Courtney step in. Courtney, why don't you share with everyone when is an appraisal needed and when is an appraisal not needed for a HELOC? I think that would be interesting for people to hear.
Okay, so different underwriters require different things. A lot of times it depends on the actual loan amount. If it's under 100,000, a primary one, single unit, most likely we're going to use what's called an AVM, the automated valuation. There are times that we will need a drive-by. I've seen very few full appraisals, but a lot of times with investments, they are required.
Right. So under $100,000 home equity line of credit typically doesn't require an appraisal. They'll just do an AVM. More than that does. Okay. The home equity line of credit can also be a first position. You don't have to have a mortgage on the property to get a home equity line of credit. Many people have properties that don't have mortgages, and they just want to have a line of credit because it's flexible. If you just take out a mortgage on the property, then what happens? You have a loan on the property, 30-year fixed mortgage or 15-year fixed mortgage, and you have to start making payments on it right away. As opposed to if it's a line of credit, the line of credit is good because it's just there for you when you want to use it, how you want to use it. And the monthly payment that you make is based upon whatever is outstanding as of that point in time. Again, it's like a credit card, but it's not compounding interest, it's simple interest. It's a lower rate of interest than a credit card, and it's tax deductible. So like this says right here, once the line of credit is approved, it takes about, what is it, Courtney, now? 2 to 4 weeks to get the line of HELOC approved. So from the time you submit documents, it takes 2 to 4 weeks to get it approved. You have what's called a draw period, and that draw period is the number of years that you can use to access the funds. And that draw period can be as little as 5 years or as long as 10 years. Now, at the end of 5 years or 10 years, whatever is left on the line of credit then becomes a principal and interest payment, and you can no longer draw. But I can tell you from experience, most people, by the time that draw period is over, the 5 or the 10 years, they usually don't owe anything on it anyway. As of that, by that point, they would have paid it all off. And if they want to continue drawing, we just can redo the line of credit, like a refinance of a line of credit. Okay. I think we already talked about. So minimum monthly payments, variable interest rate. So the line of credit is an adjustable rate. It is tied to the prime rate. It's not tied to 30-year fixed mortgages, so it's a completely different index. Right now, the prime rate's at 8.5, but it is on the decline. We believe that by the end of 2024, we're probably going to see the prime rate somewhere in the sixes. Okay. Daniel, anything you wanted to add about interest rates? Because I know you and I watch rates the same way.
Yeah, I think the main thing when it comes to the HELOC rate is that it is is significantly going to be lower than any other line of credit or money where you can get from somewhere else. I know we talked about hard money, which is an option for investors, and we talked about credit cards, which if you're looking to pay off debt or if you're looking to finance something, then you're likely going to go the credit card route. And while they would have ideally an introductory period of 0%. Once that's over, which is typically about 12 to 14 months, now you have a rate of anywhere between 20 and 30%. Where, as you said, with the HELOC, to me, if someone's looking to consolidate debt or just manage their debt payments, it's an easy way to get yourself out of debt because now you have lower payments and more flexible terms with the HELOC.
Exactly. And we had a really good question come in as you were talking. It said, do you offer HELOCs on a property that's not a primary residence? And that's my favorite question, because if you take a look at one of the earlier slides, we're going to talk about the investor HELOC. That's exactly what that is. So there is actually a product for HELOCs on investment properties that we have that very few people have. We're going to talk about that, I think, in a few slides. But yes, we're going to cover that, Brenda, there. Okay.
Here it is.
So,
Next slide up, actually.
next slide up. Oh, there we go. Okay, so investor HELOC. So what is an investor HELOC? First of all, it's a very rare product. I'm not going to say that my company is the only company that has it, but there are very, very few companies that do have this product, because traditionally lenders do not like to offer HELOCs on investment properties. It's too high risk. We have it. And it works in the same way that a non-investor HELOC works, except that the requirements and the qualifications are tighter. And I'm going to have Courtney talk a little bit more about this. Let me give you some examples of tighter. First of all, it requires a 680 credit score, preferably a 720. It is limited to, is it 80% loan to value, Courtney? 80%.
Yes.
80% what we call combined loan to value, whereas the primary residence HELOC actually lets you go to 95. Okay, so but the beauty of the investor HELOC, the biggest advantage outside of being able to get a HELOC on an investment property at all, is that we can actually put it in an LLC, and that's something that's mind-blowingly unique and attractive. And we've had a very large number of people applying for the investor HELOC because they own properties in LLCs and they want to be able to tap that equity and not have to take the property out of the LLC. So yes, the investor HELOC, and that's really all there is to it. You have to have a higher credit score. You have to have more equity in the property because, for example, if it's worth 100,000 and you already owe 70, you're really not going to be able to get much because you can only go to 80. That's only a $10,000 HELOC. And the minimum loan amount on the HELOC, Courtney, is what, 25,000? So the question I just got, is there a minimum credit HELOC? Courtney, look at the question. Is there a minimum credit score for the HELOC on a primary residence? The very bare minimum is 620 to 640, right, Courtney? But if you have as low as a 620, your loan to value will be very low. You're not going to be able to go above 60 or 65%. So when you're asking the question of minimum credit score, we have to balance that out with, I mean, if the more equity the property has, the lower the credit score can be, is the answer to your question. And then it can't be lower than 620. Okay. So,
Tammy, I think you were going somewhere with the minimum amount that you can take
yes,
out on a HELOC.
25,000.
Okay.
25,000 is the minimum, right?
Perfect.
Yes.
Okay. Courtney, anything you wanted to add? Because the investor HELOC, if we can just talk one more minute about that, that's a very complex product, not for you, but on our end. It does have layers of requirements. For example, the owner of the LLC or the individual borrowing can't have ever had a foreclosure, no bankruptcies in the past, no deed in lieu. You have to have a perfect mortgage payment history on all mortgages for how long, Courtney? The last 2 years or the last 5 years?
5 years.
5 years. So like I said, it's a great product, but it is very stringent in its qualifications. We've had many people apply for it, but they ended up refinancing. We ended up refinancing them instead because they didn't qualify for the investor HELOC, but they qualified for something else. So that's one of the things that we do is if someone applies with us for a HELOC and they don't fit inside of the box, we'll tell them what they do qualify for so that we can give them some kind of option.
And
I think
for the quick question, for the investor HELOC, is there a difference whether it's a single family or if it's a multifamily? Because I know you guys do up to 4 units. Does that process look different, or is it pretty much the same?
Courtney, that's a great question. Go ahead.
It's pretty much the same process. There are different guidelines for the multi-units, but the process remains the same.
Got it.
Right. Multi-units are generally capped at a lower loan-to-value ratio. That's for cash out refinancing, HELOCs, since the beginning of time. If something is multifamily, you generally have to put more money down if you're purchasing it, and you can capture less of the equity if you're refinancing or doing a HELOC. Okay, so cash out refinancing. All right, so let me make this very easy. A refinance, a cash out refinance, whether it's of a primary home, an investment property, second home, and we do all of them. But a cash out refinance, all it is just a lender giving you a brand new mortgage. Every cash out that's ever existed fits this definition. It's just a lender giving you a brand new mortgage that replaces the current mortgage. And that new mortgage is a higher loan amount. And so it pays off the existing mortgage, it pays closing costs, and then whatever is left over is your cash out proceeds. So for example, property is worth 100,000. You owe 60,000 on it, right? Your closing costs are 3,000, and you get you're doing a 75% cash out refinance. Well, we give you a brand new mortgage for 75,000. It pays off the existing $60,000 mortgage. It pays off the approximate $3,000 in closing costs, and then you at the closing table on the refinance get a check. Well, not that day, but usually the next day, for the $12,000 that's left over. That's what a cash out refinance does. You know, a cash out refinance is good in some cases. It's not a bad thing all the time. But what we as lenders do is we take a look and see what you're trying to accomplish. What is the interest rate on your current home? How much cash are you looking to get out? How much equity do you have? And then we make a recommendation. You know, I have had people coming to me asking me for a line of credit, and I actually recommended that a cash out refinance would be better. Now, usually it's the other way around. Usually they want a cash out refinance, and I show them that a line of credit is better. But let me give you an example of where a cash out refinance may be better. Let's just say you own a property that's worth 200,000. You have a mortgage on it of only 50,000, so that's 25% loan to value, right? And you want to take out 100,000 cash out. You want to take out $100,000 line of credit, and you want to use that money very quickly. Well, if the interest rate on that $50,000 is 6% or 5%, the cash out refinance will be better for you, because instead of at the end of the day you having a $50,000 mortgage at a rate of 6% and then having a line of credit for 100,000 at 8.5%, it's better just to put them all into one for a rate of maybe 6.75 or 7%. So the blended rate would be lower in that case. I know that's a little complicated example, but it does happen, and I wanted to illustrate that. Courtney, did you want to add anything to that? How often does that come up?
I think you covered.
Okay.
More often than people think.
Yep.
We have been, recommending the cash out refinances a lot lately.
right? Especially with the rates having come down. So it's a case by case analysis. Sometimes the HELOC is better, sometimes the cash out refinance is better. And what we do is we take a look at all the information, we make a recommendation, but if the client doesn't want to follow our recommendation, they say, no, I know you offer the HELOC, but I'd like to cash out better, or I know you recommended the cash out, but we'll do whatever it is that they want. So we don't push anybody, we just give people suggestions and advice. Now, home equity loans. So what is a home equity loan? A home equity loan is basically the same thing as a home equity line of credit, meaning it's a second position mortgage behind a first position mortgage that does not require the first position mortgage to be refinanced, but the home equity loan doesn't operate as a line of credit. It's just the straight out loan. It's just the straight out 10, 15, 20, or 30-year fixed mortgage, and you have to make payments on it right away. That's what a home equity loan is. Most people, when given the option, they choose the home equity line of credit over the home equity loan because they have flexibility with the home equity line of credit. But there are certain cases where the home equity loan is the only option without refinancing. And that's where I'm going to let Courtney, you speak. Give us a few examples of where the home equity loan is the only option for the consumer, like a multifamily, things like that.
Yeah, you know, we've talked about the investment property HELOC and those guidelines being a little tighter than, you know, the primary residence HELOCs. We do offer the HELOAN on investment properties. So if you don't meet the qualifications for the HELOC for the investors, we can go with the HELOAN. And again, that is available for multi-unit and
right.
primary, secondary, and investment.
So
that sometimes is the only option.
Right. So in other words, remember how I was talking about how the home equity line of credit for an investment property is very tight in its requirements? If the home equity loan, the requirements are much looser. The credit score guideline is lower. It allows you to go up on the units. It allows you to go up on the loan to value ratio. It has a lower credit score requirement. So those are some cases where somebody may take a home equity loan instead of a home equity line of credit.
And for those who may be getting a little confused, I have laid out pretty much the options and the small differences between the options. I think for the most part, a lot of people may get HELOCs and home equity loans confused. Generally, and Tammy, correct me if I'm wrong, the HELOC will typically have a variable rate. The loan will have a fixed rate. So if you're getting multiple options from banks or lenders, you can tell the difference between the two because the HELOC will generally have a variable rate and the home equity loan will have a fixed rate. With the loan being an option where you have access to all of that money one time and you'll begin paying on that entire lump sum versus the HELOC, which I'm a personal fan of, in which you only pay on what you use and everything else is sitting there waiting for you to use within that first 5 to 10 year draw period that you have.
Right, absolutely. So, you know, I love the way you did this, Daniel. By the way, kudos. Daniel actually created the slide, not me, and it's dead on. I mean, at the end of the day, there are different ways to access equity in properties, any property. Which way is best depends on the specifics of the situation, right? Not just the interest rate, but whether what you're going to use the money for, you know, is to purchase a new property, consolidate debt. That could dictate which option is best for you. So I'll tell you, one of the things that we have developed as a company, because we've recognized this, is that we, on our website, by the way, it's federalhillmortgage.com, if you want it, it was on the first slide. On the website, we have a link that says access my equity. And it's a little 5-minute form. Anybody who wants to just look into what their options are for accessing their equity, they would fill out that little 5-minute form. There's no credit check. But based upon that, we're then able to give any individual what their options are and also what we think is the best option for them based on what they enter, because we ask, Are you using this money to buy another property in the next 2 months, in the next 6 months? Are you using this money to consolidate debt? Are you using this money to go on a vacation? I mean, if, for example, we see that you indicate that you're going to be using this money to purchase another investment property that's already move-in ready, it's a rental, and you don't plan on refinancing that, then we're probably going to recommend the HELOAN, not the HELOC, because as long as you don't have a very high interest rate on your mortgage, as long as the HELOAN or the HELOC is the better option. Why? Because that money is going to be sitting out there for a long time, and a HELOC is not designed to borrow $150,000 against and have that money sitting out there. A HELOC is designed for flexibility, to be able to take that money out, pay it back. So you have to have an intention of paying it back within a short period of time. So these are the three mechanisms for pulling equity out of properties. Which one is best depends on the circumstances. Okay, the instant HELOC. All right, Courtney's favorite subject. So the instant HELOC, what it is, remember on the prior slide, we had the three sections, the HELOC, the HELOAN, and the cash out refinance. So what the instant HELOC is it's basically a combination of the first and the second, right, Courtney? But the advantage of it is that it happens very quickly. So the instant HELOC, it basically funds in 5 business days. We use the word instant, but there's still that 3-day period for funding. There's still, but it happens very quickly, number one. It doesn't require any kind of paperwork. It never requires an appraisal unless something changed recently. And that's the beauty of the instant HELOC, and it's an automated process. So you basically fill out a link. We email you back with, sometimes we have estimated terms, sometimes we don't, sometimes we need you to fill out a longer link, but it's an automated interactive process where within two business days, the HELOC is approved, and then within 5 business days, you can have the money in your bank account. So Courtney, talk to us about the instant HELOC.
I just had one close last week. The same day we put in the application for it, it closed the same
One
evening.
day, in one day, right?
One day.
So
One
no
day.
appraisal, no out-of-pocket costs, no
Nope.
pay stubs, W-2s, tax returns. Now
They do have to upload pay stubs.
They do have to upload pay stubs now. Okay, so that's changed.
Mhm.
All right, so you do have to upload pay stubs. You have to have some sort of income. There isn't any kind of underwriting because everything is automated, so it's not like it's submitted to underwriting and then 3 days later we hear something back. The interest rate is fixed, and there is a minimum. Is there still a minimum initial draw of 100,000, Courtney?
Yes.
Okay, so there is a minimum initial draw of 100,000, but if you don't want to use all 100,000 right away, you can always just pay it back the next day so that you don't have a payment. Yep, $40,000 minimum, and then $25,000 minimum, and then $400,000 maximum for the instant HELOC. Anybody have any questions about the instant HELOC? No, I guess we explained it very well then.
Oh, we did get a question. Is the fixed interest rate for instant HELOC higher?
Generally, yes, right, Courtney?
For the fixed,
The fixed
sorry,
interest rate for an
can you
instant
repeat it?
HELOC, is it normally higher?
It's so personalized. I'll tell you that the one that closed last week actually got better terms with the instant than with the traditional. So I can't say that it's always higher. It's typically higher.
And one of my favorite things, and the thing that stood out to me with the instant HELOC is that it like you said, it kind of has a little features of both the loan and the HELOC. But what I really liked about it was how quick you can access your money. And although it does come to you as a lump sum, the strategy of being able to pay it back instantly and then it turns into a HELOC was something that I really I don't think it exists anywhere else. And I just thought that was a unique feature. So for those who don't really understand the instant HELOC, I think that's really where the benefit comes in, is that you can access your money very quickly. It is a loan, so you get all the money up front. After you pay that money back, it turns into a HELOC. And Courtney, typically, how long do you have that the HELOC for after you've begun paying that back? What's the draw period?
So the instant HELOC has several different options. It can go 5, 10, 15, and 30-year terms. And in those, the draw periods are either 2 years, 3 years, 4 years, and 5 years.
Got it. Awesome. So next steps. If you guys, unless you guys have any questions, I mean, we're opening it up. So please, if you guys have any questions on anything that we touched in, please throw it in the chat. But as far as next steps in taking action, the first thing that you'd want to do is take a look at your mortgage statement balance, get an idea of how much left that you owe on your property, whether it's an investment property or something that you're currently occupying in. Reach out to me, or if you're not in the DMV, reach out to your local real estate agent. They're going to be able to provide you with a CMA, so you can kind of get a sense of what the current value is of your home. And then, of course, you want to connect with Tammy and Courtney to discuss your options. As you see that there are a multitude of options out there for you to leverage the equity that you've built over the years in your home without having to sell, without having to refinance in a lot of instances. And so it just starts with a conversation. What if I bought my house 1.5 years ago?
You could have bought your house 6 months ago and you're going to be eligible. That's actually a very good question. So, okay, so this individual said 620,000. So you bought your home for 620,000, right? The question I have is, how much do you owe on it currently? If you can type that in the box, and then I can illustrate that for you. 550. Okay, so this is good. Let me show you. So you'd like to get a home equity line of credit, right? So if you bought your home for 620, yes, okay. If you bought your home for 620, obviously that's a primary residence, not an investment property. In order to calculate the maximum amount of the home equity line of credit that you can get, you take 620,000 times 95%. I'm doing it right now on my phone. If you see me looking down, 95%, that's 5,000, that's 589,000, right? You say you owe 550, so 589 minus 550, that gives you 39,000. A few $1,000s of that goes towards closing costs, because there are closing costs associated with opening a line of credit. So at the end of the day, you'll probably end up with about 36,000 on a line of credit that you could access. Okay. Now, this is an interesting question. I'd like to use this as an example of something. So if you have a mortgage on a property that you took out a year or less ago, and you have equity, like this individual, ton of repairs, I'll talk about that in a second, and you'd like to take out a line of credit, that's fine. We can do it based upon what this individual entered. We can do it. However, take a look and see first if maybe that mortgage needs to be refinanced into a lower rate. And here's why I'm saying this. And Courtney, I know you know where I'm going with this, is that once you take out, one of the disadvantages is that once you take out a line of credit, it becomes a little bit more costly to then later go back and refinance that first mortgage, right? And most people who've taken out a mortgage in the last year, not most, but many people who've taken out a mortgage in the last year are eligible for refinancing now because the interest rates have dropped. So that's one of the things just to think about. Take a look at that mortgage. If that mortgage can be refinanced into a lower interest rate without cash out, do that first and then get the line of credit afterwards. Just because if you get the line of credit first, then you go back to refinance, it's still possible to do. It just gets to be a little bit more costly because then you have that second position HELOC behind the first mortgage. Now, this individual also said, what if I did a ton of repairs and renovations? I mean, that's great. All of those repairs and renovations, they speak to the value of the property. So based on that, if you bought it for 620 and you did, maybe it's worth 650 now. And if it's worth 650, then that calculation that we just did completely changes, right? So you'll take 95% of 650, you'll subtract 550, which is what you owe from that for the home equity calculation. And then whatever is left minus closing costs, that's your home equity line of credit that you can take out. Okay. Hopefully that helps. That's a great question. I like that question. Anybody else have great questions? You're welcome. Thank you. You're welcome.
Someone had asked, are these products available nationwide or just in the DMV area?
I believe they are available nationwide. However, we can only offer them in the 7 states that we're licensed, which is Maryland, Virginia, DC, PA, Delaware, North Carolina, Texas. Those are our states. Texas is limited though. Texas does not like home equity lines of credit. So we can still do them in Texas, it's just that there are additional rules. Something else, I guess, while we're waiting for another question to come through, Daniel, I'll mention is that one of another purpose of the line of credit or the home equity loan is avoiding mortgage insurance, right? So people will frequently, you don't have to just use it to take equity out of a property that you already own, but you can use a line of credit to structure a purchase. So let's just say you want to buy a primary residence. It's for 500,000 and you just want to put 5% down. Well, if you put 5% down, what does that do? You get a mortgage for 95% is the way that we look at it from the mortgage side, right? So it's a 95% loan to value mortgage. Well, we all know anything over 80% loan to value has mortgage insurance, right?
Right.
Now, mortgage insurance isn't terrible, but if you want to avoid mortgage insurance, what many people do is that instead of taking out one mortgage for 95%, they'll take out one mortgage for 80%, thereby avoiding mortgage insurance, and then a second mortgage for 15%, and that second mortgage is the home equity line of credit or the home equity loan. So that's something that people do as well, is that they will split financing into 2 pieces, the first mortgage and the home equity line of credit or loan from the jump, just to avoid the mortgage insurance. And likewise also, when they're taking equity out later, the goal is to avoid mortgage insurance if you can. Now we got another question here. Brenda asked, did you say that you're licensed in Maryland? That's a great question. I am not only licensed in Maryland, I am in Maryland. My office and my company is based in Baltimore City. And I am actually the #1 producing loan originator in the whole state of Maryland. I don't know if I mentioned that in the beginning. So yes, I am definitely in Maryland. Yep. Now, a couple things about the investor line of credit, Daniel, if I may add. This
Please.
comes up a lot, is that the investor line of credit, one of its requirements is that the individual cannot own more than 10 properties. Not just 10 finance properties, like Fannie Mae, Freddie Mac, they have a 10 financed property rule. But when it comes to the HELOC, it's literally 10 properties, whether they are financed or not. And that includes any properties that are owned by the individual's LLCs. So if you're an investor and you own 5 properties in one LLC and then 5 properties in another, you have 10 and you're fine. But if you have 5 and 6, then you're at 11 and you're out of the parameters for qualifying for an investor line of credit. And all that means is that we just have to use a different mechanism for you to get the cash other than that. Okay.
That brings me to a quick question, Tammy, on that subject. Is there a limit to the amount of HELOCs one can get out of? Because I know there are some people in here with portfolios of properties, and let's say you have 3. Are you able to, let's say you move into a property, take a HELOC out, and then when you move into another one, take a HELOC out? That way you have access to these lines of credit when you want to use them in the future?
Right. So the only limit is with regard to the specific investor line of credit product, which is one subset. It's not the only kind of line of credit that we have. So with the investor home equity line of credit, there is no limit on the number of lines of credit you can take out. There's only a limit on the number of properties you're allowed to own to begin with. So if you own 10 investment properties or 10 properties total, including all, not just investment properties, 10 properties total, you can take out a line of credit on every single one of them. But if you own 11 properties, you can't take out that line of credit on any of them. Now, right, in those cases, there's typically something else that we can do. So I'll tell you, as much information as we've covered today, the investor HELOC, the primary home HELOC, the instant HELOC, the cash out refinancing, we still have other products available. Those are just the most typically used ones. So usually the way it happens is a client approaches us and says, okay, this is what I want to do. This is the product I think I'm going to fit in. If we can't fit them into that, we'll give them the next best thing. Just got another question. Okay, let's see. 2 questions. Geneva asked, what if the person is retired with no W-2 income, and are they still eligible to apply for the instant HELOC? The answer is yes, absolutely, as long as whatever income they have is sufficient to meet the debt to income ratio. It doesn't have to be W-2 income. It could be any kind of income. It could be retirement income. It could be VA disability income. It could be self-employment income. It could be rental income. As long as it's enough, right, then it's going to work. The W-2 income is not a hard and fast requirement. The issues that we generally see aren't with that, Geneva. The issues that we generally see are with people who are self-employed that have the income but don't show anything on paper, in which case they're not going to qualify for the investor HELOC, but they may qualify for maybe our bank statement loan HELOC, which is something we haven't even covered, but we have. The next question is, if you do a HELOC to purchase, then sell the property, can you continue to pull HELOCs to purchase and sell other properties? Okay, so you're welcome, Geneva. So if you do a HELOC to purchase, it depends on which property you're doing the HELOC on, right? So if you own 123 ABC Street and you do a HELOC on that property, and then you sell that property, well, then that HELOC goes away because that HELOC is attached to that property. You can't draw on that HELOC anymore because you no longer own the property and the HELOC is secured to the property, right? But you can still do HELOCs on other properties. So the HELOC, again, is tied to the property. Once the property is sold, that HELOC disappears.
One thing that, and Tammy, you mentioned this before, one thing that I did have a client do was take a HELOC out on her primary residence. She was able to get up to $200,000, maybe a little bit more, I think. And she used that money to purchase her another property in which she went out to fix and flip. So she was able to use that to acquire the property cash, put additional money into it, fix it up, sold it, made a profit, and then paid off her HELOC. Now, because she's only within, I think, 2 years within her draw period, she can do that over and over again until her draw period is up. For anybody out there looking to invest, that's kind of how the strategy would work.
Yes, 100%. What Daniel just explained is the most common thing that people do. And it is the best way to do it, let me tell you. Because the line of credit that you take out on your primary home, first of all, is going to be typically the largest, right? Because primary homes are worth more. And the line of credit that you're able to take out on your primary home is also going to be the cheapest. In the world of lending, since I've been doing this for 18 years, and I think until the end of time, money that is borrowed, remember this rule, whether it's a HELOC, a cash out refinance, a purchase, whatever it may be, borrowing money against the primary residence is always going to be cheaper than borrowing money against an investment property. So if you have equity in your primary home, get the line of credit on the primary home first, and then get the lines of credit on your investment properties if you own investment properties second. That's always going to cost you more money because interest rate will be higher. So what Daniel just explained is the most common mechanism, and it's the most common because it's the best one and it's the cheapest one. Get the biggest line of credit that you can on your primary home. If you've recently purchased it, it's not going to be as much unless, as somebody mentioned, you've made improvements and the value is actually higher. Get that line of credit and then use that line of credit to reinvest. And then if you buy a fix and flip, you sell it, you pay off the line of credit, you do it again. You could do that with hard money also, but again, you're going to end up with a lot less money in your pocket because the hard money would have eaten up a lot of your profit. And that's what most people do, by the way, who don't know any better, who haven't been on this webinar. I see many, many people taking out hard and private money. That should always be the last resort. Last resort. If you have a line of credit on an investment property or a primary home or anywhere, you have a line of credit and you use the line of credit to do whatever it is you want. In this case, buying another investment property, right? And then, but once you pay that down, like let's just say in your example, you fixed and flipped and then you pay that line of credit down. Now, all of a sudden, you still have the line of credit. It doesn't start over. It just has a zero balance. That's really your answer. It has a zero balance. You don't have to redo it. You only have to set it up once. You have closing costs once, which is the beauty of it. It's not like hard money. Every time you take it out, you pay 5 points, right? So the line of credit is still there. It doesn't go away. It doesn't close. It just has a zero balance. The only way it goes away is if you sell the property, but it's always going to be there. And then you can use it, pay it up and pay it down as you wish. Something else I'll mention since we have a couple minutes left and nobody has a question posted. Remember how I said a line of credit that you borrow against the primary home is going to be a lower interest rate? If you're in a situation where you're planning to convert your current primary home to an investment property, right? It's a good idea to hurry up and get a line of credit on that property before you move out, right? I get this question a lot as well, because if you get the line of, if you think you're going to need a line of credit and you wait until you move out to get it, the interest rate's going to be higher on the line of credit. Once you move out, it doesn't change. You still got that primary residence home equity line of credit interest rate. So think about that as well. If you're buying another home or thinking of buying another home in the next year and you own a primary home that has equity, let's just get you, and you think you may want to use that equity for something, just go ahead and get the line of credit now, even if you're not going to use it, because you don't pay interest on any money that you actually, unless you borrow against it, unless you draw on the money.
Yeah, that's great advice. I think for myself, I'm personally kind of in this strategy where any property that I purchase, my plan is to live in it. I'll purchase it, live in it. If I have to fix it up, I'll do that. And then the goal is to rent it out. And that's how I've sort of been on this journey to build my portfolio. And on that road, like I've learned that while you're in the property is where you should kind of be exploring all these avenues. Don't wait to leave because things get a lot more expensive, or like you said, like just the money on the rates get a little bit higher, because at that point it's viewed as an investment property, not owner occupied. So if you're currently living in a property and rates are better than when you purchased it, now's the time to look at refinancing. If you don't have a HELOC on the property, now's the time to look at doing the HELOC before you move out and decide to rent that property out, because once you do, it's look different in a lender's eyes, and you're not going to be able to take advantage of the same opportunities.
And by the same token, you don't want to wait until you find another investment property to buy to start the home equity line of credit process, right?
Yeah.
If you have equity in a primary home or an investment property and you're out there browsing, looking at homes and thinking, oh, as soon as I find a good investment property deal, I'm going to jump on it. Get the line of credit now, because you know how it is. You find that property, you want to jump on it. They may want to see proof of funds to make a cash offer, and you can't show proof of funds unless that equity line of credit is in place, right? And the faster you can show that, the faster you can close, the better deal you get, right? We all know that. So I encourage anybody who is thinking about it to open a line of credit sooner than later so that it's there for you when you need it.
Awesome. Well, that wraps us up. Tammy, Courtney, thank you so much. Thank you, everybody who joined us. We'll make sure to get this out to everybody. If you guys have any questions, Tammy's information is there, my information is there, but we'll send the email out to everybody so you guys can reach out to us if you need.
Thank
Awesome.
you, Daniel.
All right.
Excellent.
Thanks.
And you're welcome.